Hey everybody, today on the show we are continuing our series on low and no money down financing options for 2020. And so we're excited today to have Kevin Miller with Jet Direct Mortgage in the office with us. Kevin, thanks for being here with us.
Absolutely.
We are going to talk a little bit today about conventional loans, and there's a couple different out there. Today we're going to focus on the 97% loan to value options that you have. So that's a 3% down home mortgage. And so Kevin, we'll just kind of dig in. So let's talk a little bit about those. The first thing that a lot of people want to know is, and as we're talking about this particular set of mortgage options, what is a minimum credit score that somebody would need for this kind of conventional?
On this product, we're going to be looking at a 620 credit score for conventional loans.
Okay.
97% options are obviously, we'll get into some of the particulars because there's a few options that we want to look at and where some things would be better than others depending on, each person's circumstances.
Okay. And we say obviously 97% down. So we're basically talking about a 3% down. So for easy math, $100,000 house, if you can find that, theoretically you're talking about a $3,000
Correct.
down payment. Now, just to want to clarify, what a down payment versus closing costs, things like that are, because ultimately the buyer wants to know how much do they need to bring to the closing table. So let's talk a little bit about what their costs are versus the down payment, and what is the actual minimum requirement that they're going to be looking at.
Yeah, so obviously we're talking about a 97% financing. So as you said, 3% down depending on the loan size, 3% of whatever your purchase price is going to be the minimum amount that you're going to need to put down in order to qualify for the product.
Okay.
Beyond that, I tell people when they talk about, well, how much money do I need? I usually say, well, you're not buying the house for $100,000. You're buying it for $100,000 plus your closing costs. Those closing costs consist of attorneys and appraisals and third parties and title insurance and all the things that are coming into it. And I go through that with everybody, just line by line and know what they're paying for. On average, with the price points that we see in Wilmington and even across the river in Leland and most of the Tri-County area that we have, I would say anticipate about a $5,000 marker for setting up your escrow accounts and all your things that are associated with closing. Now, whether or not they bring that themselves, or whether you enlist the expert agent to come in and negotiate on your behalf for seller concessions, that is kind of up to them on the negotiation side. Right,
and so in talking about that, because that was actually obviously my next point, we're trying to limit as much out of pocket, for the buyer as we can, and so we know they got to bring minimum 3% down. Mm-hmm. That's going to be the loan requirement. So, but with this particular loan on the 97%, what are we're trying to get closing costs paid for by the seller essentially. So with that in mind, what is the max contribution that these loans allow for seller contribution?
Anything when you get into anything over 90% loan to value, you're going to be capped at a 3% seller concessions or interested party concessions. That could be agents, that could be sellers, that could be any combination thereof. Okay. So let's stick to the normal thing, the seller concessions. So 3% being your cap, and again with the average purchase price being over $200,000 in this area, it's very rare that you're ever going to have a challenge to be able to fit all those closing costs in if you can get the seller to agree.
Right, and so obviously it's important, typically what we do is when we find the house or a group of houses that our folks like, we'll come to you and we'll say, here's the house that we're looking at. Let's estimate out, what our closing costs are going to be so that we're writing that offer to try and get as much of those paid for as possible.
Absolutely, and there's other times too where people don't, I think, realize, you can work, especially with interest rates as low as they are right now. A lot of people don't realize that there are ways to use the market to your advantage. And what I mean by that is, let's say that you have good credit, everything else, and the interest rate is 3.875 on the transaction that you're looking at. Well, you might be, say, $1,000 short of what you need to close on the transaction. Mm-hmm. You might be able to work with your lender and say, well, if I was to get an above par pricing, what would you give? What would you be able to give me back in a lender credit? So what that means is you could take an interest rate that might be 4% or
sure.
4 1/8, and that could bridge the gap in order to make the deal work for you.
Have that rate
and
credit, sure.
And it honestly, people don't realize how little that can really be. I mean, you could be talking about $23 difference to your payment, and it could be the difference between you owning that house or waiting 6 months to save up that extra $1,000.
Right. No, absolutely. And so, in talking about, the down payments as we're mentioning right now, as somebody says, okay, well, I've got 3% here and maybe a 3.5% FHA, kind of decide between some of the two. Are there gift options or anything with the conventional, whereas FHA does allow some of that? Is that something that is allowed on the conventional side?
Absolutely. Gift options are considered basically borrowers' funds. Depending on the specific programs, there may be some specific instances where they're going to want a very minimum contribution, meaning $1,000 of the borrower's own funds, but that usually only applies if you have non-occupying co-borrowers and other aspects of the file. But the rule of thumb is, yes, you can have the gifts. You can have a gift from a family member to help you in order to achieve that 3%. That is perfectly allowable. You mentioned FHA. One of the biggest things why I like the 97%, say versus an FHA is there's no upfront mortgage insurance premium on these conventional loans. Okay. So you don't have that added amount added to your loan amount that people are going to see, which can get pretty pricey at one point. Secondly, your mortgage insurance that you will have mortgage insurance on any loan sure. that's over 80%.
Right.
But this is like any other conventional loan, even the 97s work this way, where that can actually be petitioned for removal or will automatically remove off of the file over time. Okay. So you have this luxury, whereas FHA, you have it for life. So.
Yeah. Absolutely. And so, switching to kind of interest rates a little bit, obviously everybody's situation is different. It's going to depend on their credit score, things like that. But in terms of comparing overall, products of mortgage types of low down, whether it's 3.5%, 3%, 5%, that bundle of products there, what would you say in terms of the conventional? All other things being equal, is the conventional going to be kind of a good, better, best in terms of interest rate for the borrower?
If you're looking at sheer interest rate without factoring in the upfront mortgage insurance premiums and things of that nature, the interest rate on the conventional on these 7 will be slightly higher. I think we've talked about it before, but the 97% conventional comes in 2 different forms. It comes in a standard conventional, which has very limited to no restrictions, and then what they call a home possible or home ready. There's 2 different options there that have a actual interest rate cap, meaning that no matter what your credit score is, there's only a certain amount it can be bumped up based on your credit profile. Okay. It also has a reduced mortgage insurance option. So I think that ultimately you're going to be a little higher on the interest rate from a standpoint of an FHA. But a couple things to consider. You don't have that upfront mortgage insurance. You typically can have a lower monthly mortgage insurance premium. So you might find that even though the interest rate might be a quarter or 3/8 higher than, say, an FHA, your payment itself is actually lower in a lot of scenarios. Right. So that's why I feel.
And talking about that, what I would tell the audience, obviously, Kevin does all these different kind of loans. So, what we typically do is we'll take our clients, we'll partner them up with Kevin, and Kevin will lay out all the solutions for you. So, depending on your situation, where it's really, whether it's more, I need to focus on limiting my out-of-pocket, or I'm looking at a specific down payment or a specific actual monthly payment. Those are the things that we'll assess all the way around to see what best loan product is for you. And so, and in that vein, let's talk a little bit about what these 2 97% products, who are they really for? I know there's some talk about first-time, home buyers, things like that. But there's some things that people may or may not know about that. Do you want to explain that a little to us?
I think the biggest one that I typically, if I have somebody that comes to me that says maybe over a 680 credit score, maybe even pushing 700, but they're that first-time home buyer, they're somebody that's, wants to get into a home and say maybe 3 to 5 years, do something with it down the road, as far as a step-up buyer kind of situation. I would bring them into that for a couple reasons. One, again, I that upfront MIP you can't get out of. I don't like to put it out there unless we absolutely need to. Mm-hmm. Secondly, the monthly mortgage insurance at those levels is cheaper than it is at FHA, and you can get it removed, as you're seeing how much our properties are valuing and increasing in value. Sure. So the opportunity for somebody to petition for that removal can happen relatively quickly depending on their scenario. It's one of these things where I look at it and say I do an analysis, to your point of saying, here's what this one looks like, here's what this, what is our goals? Not just acquiring the property, but what's your long-term goal? Are you going to be here 3 to 5 years? Are you going to be here 2 years? and we can kind of analyze what the best solution is for them on that. To me, anybody that has, again, that has a 680 or better credit score, income-wise can fit into one of these 97 structures, like the Home Possible or Home Ready. There are some income caps of about $57,000, about $50,000 in Brunswick County for the household. If they fall into all those things, I'm going to show that product first, and I'm going to compare it and show them why I think it is. And ultimately, it's because I can get the best payment. And at the end of the day, it's really that's really what it boils down to. How much are you spending every single month to own that home?
Okay, you talked a little bit about income restrictions and things with that. So in keeping with that theme, let's talk about debt to income ratio a little bit, and also, what types of homes, is this product for? Are there restrictions on that in terms of, condos, townhomes, manufactured, any things like that? So just, can you touch a little bit up on that? 1 to 4 unit, which is going to be anything from a single family stick-built home or a townhome. Condos are eligible, but they are going to be subject to meeting the agency, Fannie Mae, Freddie Mac guidelines, which just means that the HOA has to be in a healthy position. They have to have reserves available for the account. Condos are like I said, eligible. And then lastly, there are options for manufactured, but there are some restrictions. It's mainly about the age of the property and the age of the manufactured as well. But it can be done. Manufactured modulars are considered the same as almost stick built, but it's that manufactured mobile or double wide that you definitely want to get that checked out and verify that that's going to fit into the product. So because there are some limitations there. Okay. And so what are our debt to income ratios on these particular 97% loans?
Debt to income is going to be based on the AUS findings, the automated underwriting findings. So it's just a computer system that we run it through and check it out. So, but the top allowable would be 49.9%. Obviously, you would love to see anybody having somewhere around 45 or less percent, that ratio. That would be your target goal for anyone. And quite honestly, a lot of times I'm going to talk to a borrower about that. If they're above 45, I want to really look at what they're doing, because we never want to put someone in a position where they're going to be jeopardizing their family or their situation because of trying to afford a home.
Okay.
But we'll make sure that there's and there's so many reasons why it can go over 45. Maybe only one party's on the loan. There's other income that we're not considering into the transactions.
Well, great. Well, that's some great information on that. We just wanted to kind of get some baseline information to our folks so that they can start thinking about what they want to do in 2020. And so we encourage you guys to reach out to Kevin, and if you've got questions about whether it's these 3% or FHA, anything, any loan type at all, or you just want to kind of find out maybe what scenario is best for you. Kevin, how can they reach you?
You can reach me, basically the easiest way to get me is my cell phone, 910-465-2414. Give me a call. I'm happy to go through any of these scenarios, and also can get up with Chris, and we have connections to some online versions that we can connect you with.
Absolutely. We'll be happy to help you. And so, Kevin, appreciate you coming in today to talk to us about that.
Absolutely.
And hope that helped you on your information about mortgages, getting ready for 2020, and we'll see you soon.